There is the man of the half hour, Noel Smith, Convex
I'll
Asset
take it.
Management. How are you doing?
Hello, how are you?
We're doing great. So far, so good. Limited technical glitches, which is something that we can always say is a positive.
Ooh, baby.
We've had some great conversations. And so I've been left solo here because you are the vol practitioner. And in theory, I can ask you some qualified questions. Um,
I feel abandoned.
no, you shouldn't feel that way. You've scared everyone out of the room.
Yeah, I doubt that. That's usually only up to the girls.
Yeah, right. Well, I have a multitude of things to talk to you about today. Um, for everyone who is, maybe new to Noel and what you do, why don't you give a little bit of a background so people know what we're going to be diving into over the next 30 minutes?
Sure, I'll keep it short. I run a hedge fund called Convex Asset Management. I started out as a prop trader in the late 90s. I was a market maker, did a lot of stuff I worked on the floor, ran an entire prop firm, hired something north of 100 guys, was involved in high frequency trading and the genesis of that in Chicago. And now I run a hedge fund.
Yeah, we've had several great conversations over the past several months, maybe even years, around volatility and what you're seeing. And I really love your views. They're very interesting and dynamic. So what I wanted to start with here is we have FOMC tomorrow. Obviously, there's the Treasury announcement that people, I think, are maybe making a bit too big of a deal around. But I'm not qualified to make that. I just say that because vols were not very reactive to that announcement last night. We had a very quiet vol regime, I would say, at least from the index side, into April. And then with April, things started to get a little bit wobbly and vol moved up a little bit, at least implies did. Can you sort of set the stage for us now, where you think we are, the barometer of, reaction to things, and what you're looking at now, just with the general environment, what could be triggered with tomorrow's announcements, how the next couple of days and weeks may play out.
So if you said to me, here's the future, and we went back to where we had 6.5 rate cuts priced into the marketplace, and then you said, okay, we can go to April 30th. What's your book? Tell me the trade. And I would say the market's down. I would say the vol is higher. The market's down more.
I'd agree.
And it just goes to show that even with that foresight, even if you told me what was going to happen in the future, I still don't really know that I would have got the trade right.
Yep.
Because I would have expected a lot more volatility. We've had some, but not that much. And if you look at the forward volatility, it's not that high and things aren't really all that crazy. So to answer your question specifically, obviously vol's not that chill. Obviously vol's not that high. If you look at, we could talk about this for an hour, but if you look at the vol complex writ large, it is just not really all that dangerous.
Yeah. And my view, and I love your interpretation of this, is that in April, even though, yes, the VIX went up towards 18 and vol implied vol moved up, realized vol S&P index just seemed very sleepy through the entire, move down. And yeah, we lost, I think, 4 or 5% at the lows into April when we hit 5,000-ish in the S&P, but there never really seemed to be that kind of forced short cover move and real big vol spike, realized vol spike. On the index side, we saw NVIDIA and the single stock side really move a lot, but index vol really seemed to be rather sleepy, and that's in the face of geopolitics, rates creeping higher, correlation started to sneak back up a little bit. What do you attribute that? Number one, do you agree with that view? Of course, feel free to say no. I obviously will if you say so. But what do you think was like a driver of that? And do you think that's going to be a continued relative reaction? In other words, index vol is going to remain sort of benign or contained rather versus single stocks?
There's a handful of questions embedded in your statement. So the amount of, kinetic energy that requires the marketplace to keep going up, I think is kind of fizzled. We went to kind of a more of a stall speed altitude. But then if you couple that with some of the geopolitical risks, and also some of that happened overnight, right? When, some of this stuff was happening and the markets went pretty crazy overnight. By the time people figured out what was going on, and it was more a bit of political theater or war theater with very little actual damage,
Right.
things chilled out quite a bit. And if you look at what was oil doing overnight, it was very busy. What were E-mini futures doing overnight. It was very busy. Everything was very busy. And then by the time the market opened, it wasn't that big of a deal. So do I think, to answer the question, do I think that we, go crazy or chill out from here? Of course, I have no idea. But in terms of how to trade it, there is nothing saying that the market is imminently going to crash or imminently going to rally right now from a volatility lens. And bear in mind, the reason I traffic in volatility and not macro, I know a lot of people like to talk about stories and stuff like that. I love a good story as much as the next guy. And frankly, as humans, I think it's easier for us to connect on that. Like, if this happens, then that will happen. Maybe. Again, going back to my original analogy, if you told me that all the price cuts were going to be priced out of the marketplace, I would have told you that the reaction function in the marketplace would be substantially worse for the market. And it really hasn't been. We're down a few points, no big deal. But if you're looking at it from a mechanical standpoint, what is volatility right now? What is forward volatility right now? It's really just not saying that you have to worry about too much.
Yeah.
And I think the election also probably goes into that.
Yeah. We had touched on the election a little bit earlier. And it's, sorry, three thoughts came out at once. When you look at the reaction function, I think that's a great way to place it or frame it, is that a lot of times, even from a macro perspective, you can be right and the market still just doesn't care. And so that reaction is important. We did see term structure kind of elevated a little bit around this morning's data versus last night's close. And so I think some of that, next week's ISM suddenly is pricing a little bit more movement. So there's some small reaction in there. But you brought up the election, so we can kind of latch onto that. If you look at term structures, they're starting to elevate, or there's a kink in those term structures tied to the election. When do you start to think of that having an impact? And from maybe a positioning perspective, is that supportive for the markets here over the next couple of months? Are we still too far away from that event? How do you look at the election and positioning?
Well, I think that you could trade it at any time. It's always going to be roughly fairly priced. If you look at where's the kink, it's in October, because it's a 30-day hence saying that the election might be busy. I don't think the election is that big of a deal because we already know what a Biden presidency looks like. And honestly, we already kind of know what a Trump presidency looks like. And we've very rarely been in this situation where we kind of have seen both data. And I think where the real volatility might come from is if there is some kind of totally exogenous event, like a contested election, attempted or consummated assassination, something that's actually crazy that nobody is really expecting. And I think that if you look at the October and November VIX futures, they're probably going to carry I can turn my head and look at the quote, but I'm pretty sure I'm right. The November VIX future, I think, is like 1820, and it's down about $1 in the last 30 days. And the October future is about 19 and high change. And both of those are about right. And if you look at a call spread structure in those things, they're carrying pretty well. So if that's what you want to do to hedge, if you hedge today or a month from today, it's not going to be that different. You're going to pay, 48 to 54 cents for a $10 wide out of the money call spread in the VIX. What are you going to do? Are you going to wait 45 days to get 43 cents? Sure, maybe. But then if something actually does happen, you're going to waste it. It's just not that big of a deal.
Mm-hmm. And so we've sort of been shrugging off higher rates, geopolitical escalations and the like. When you look at sort of the reaction, the volatility reaction to some of these events, and we know that we have the election, coming up in a couple of months, you're sort of inferring that the market not reacting to anything is a signal in and of itself. If I take if I take it correctly. And so if we clear FOMC tomorrow, I sort of read it as like, if Powell's sort of like neutral to dovish, that's positive for the market. And unless he's like overtly hawkish or catches people off guard, then that should release some event vol, and that should be a little bit of a tailwind to markets. How do you look at trading an event like tomorrow? And I know, do you trade a very short dated options around this thing? Or are you considering more a month out in time? And what's the general way you look at tomorrow and how you would generally position around events like this?
Going back to the reaction function. Okay. You have to game it out. Every scenario. If he says this, what does the market do? If he says that, what does the market do? And he says nothing, what does the market do? What if he says three of those things? What does the market do? And what the market is basically saying is that we're in the middle of a political season. The RNC and the DNC convention straddle FOMC. What is he really going to do? Is he really going to chop rates 100 bips I mean, that's priced out to 2025, so
Right.
the end of next year. It's just not that much. And the other side of that is he going to raise rates 100 bips? Okay, fine. Say the jobs number comes in 3x what it's supposed to be on Friday. It's 750 grand. Is he going to raise rates 100 bips? But again, even if you have the future knowledge, what is really going to happen in a political season? And the marketplace is saying not much, because he wants to keep his job. And even if he doesn't care about keeping his job, the apparatus around him probably does want to keep their job. So what they don't want to have happen is, the administration is come in and take their arm and sweep the whole desk clean of all the personnel that are relevant to this business. And the marketplace, and I would agree personally, says that probably not much is going to happen, barring a real war in the Middle East, and then therefore oil shock price up, and which means, a new spiral in inflation. Okay, that's new data. But so far, the conflict in the Middle East, insofar as oil prices and bond prices have been involved, it hasn't been that big of a deal.
So somewhat related to this, we tie back this idea about index volatility versus single stock volatility. Certain measures of dispersion were rather high throughout this year as chip sector stocks and the like really moved a lot higher and faster. And index vol seemed to be a little bit lagging. Number one, do you sort of agree with that statement? Obviously, feel free to say that you don't see it that way. And do you think that
Yes.
there's a chance that we kind of rebuild or continue on with that structure, particularly in light of earnings season coming up now? And I would just say the reason I bring that up because I'm curious if you're just an equity investor, does that force you having to take more of a kind of a specified approach? In other words, like a factor approach. Like I really need to get into chips here. I can't afford to just hold the index here. I really need to chase sectors that are working.
I think your question is saying, is it better to be a stock picker or an index picker right
A much
now?
more
But I
succinct way to put it. Thank you.
So if you think about, again, everything is a reaction function. So if you punch me, what's the reaction function? Do I cry? Do I punch you back? Like what you're doing is you're giving me an input, but now what you're waiting for is my output.
Mm-hmm.
And that's the thing. So if your input is rates aren't going to change that much, what is going to change? And what is their function in the marketplace? How do I trade this? Ultimately, this is what all this is about. We're trying to figure out what is the trade. So that's why I don't really delve that deep into macro. I love good stories,
Mm-hmm.
but I can't tell you how many, macro stories that have been so logical to me that it just never worked out, or some other random story that I wouldn't even have thought about that did work out. And at some point you're just like, I have no idea. Like the Bill Ackman Herbalife story. That was a great story. I mean, if you thought the thing was going to go to zero in a day, it just never did. Well, it took a long time. But my point is that will it be a good time for correlation dispersion trading? I think it will be. I am talking my book. I have it on, but I could take it off in 5 seconds if I didn't like it. The idea that you're going to have a reshuffling of the deck chairs with the boat still basically staying on course, I think is the case. And the reason I think it's the case is because look at like the ZN futures volatility right now. The tomorrow volatility in the options on the 10-year note is about 10 1/3 vol. That's what that's saying is that, the straddle is being priced in X amount of ticks, and it's going to come in on Thursday and come in even more. So probably something around 7. And if you look at the vol structure after that, it's about 7 from here on out. No problem. That isn't that big of a deal.
Right.
Everybody loves to like talk about negative stuff because there's something in humans that gets a better reaction out of it. And I can be like a talking zero hedge, right? And just always be scaring people, but there's no data. We want to try to keep this in the domain of data and what is actionable. What is actionable is the data isn't freaking out. What is actionable is dispersion is working right now and will continue to probably work for the same reasons they've been working for the last 24 months, which is to say that there is uncertainty in rates, the trajectory of rates, the rate of the trajectory and change in rates, and then all the things that go with inflation or whatever else, because the economy is hotter than what was anticipated 6, 7, 8 months ago. Rates have not come down. They're probably not going to come down anytime soon, at least not at the rate of change that people have talked about. And we're kind of in a holding pattern. So what does that mean for the trade? I would say that it is a stock picker's environment. I would say that picking your sectors and then the names within those sectors is favorable. And if you don't know how to pick names or pick sectors, correlation is an excellent way to trade that.
Yeah, and somewhat to your point, tail risk that was prevalent just a couple of weeks ago really collapsed pretty sharply. I want to touch on the topic of correlation and dispersion because a lot of what's been going on in the options space, recently was discussions around call overriding funds, obviously with like Jeppy adding a lot of, in theory, positive dealer gamma to markets, and you have zero DTEs and different things like that. Do you think that those are factors at all in the way that S&P volatility is reacting relative to single stocks, or do you think it's more of a function of, trading flows, like people running dispersion strategies?
It's always both. So I was just at a thing with the SIBO. We were kind of going through all this data, and the story part of this conversation wants to say something like, well, if the market dumps a zillion Vega on the marketplace, or if, then it's going to have a net effect. But if you look at what's happening in like zero DTE, what's happening in the Vega space with correlation trading, it's pretty balanced.
Mm-hmm.
And if you look at, the percentage and the number of options being traded in zero DT or near tenors is high and higher all the time. What is the actual effect on that in terms of gamma? Well, you would say, if you, again, you called me 2 years ago and say, listen, I got the future. Here's what's going to happen. We're going to send, 50% of the volume is going to happen in zero DTE. I would say, well, they're going to take front week vol down to 3, because if that's all they ever do. That's just not happened. So if you look at the narrative, which is to say there should be a lot of effect because of this stuff, but then you look at the actual data, it hasn't changed anywhere near as much as I would have predicted. So is there an effect when the marketplace has structured products that come in and there's a different reaction function? I feel like such a talking head, but it's true. So what is going to happen with some of these structured products? Well, if you got a lot of these like buffered and collared strategies where the people are protected down 10%, so they don't have to wear a helmet for 10%, well, maybe 12% is the new 10%, or the 12% is the new 2%, right? Because what's happening is you're sliding stuff down, and people are going to be compelled to freak out at different new levels. So what was a vol shock where VIX was 35, maybe that new vol shock is VIX 45. What is the price of the skew on the out of the money call in variance space in VIX? It's going to be higher. And the reason it's going to be higher is because the reaction function has been pushed. That risk, Chris Cole used to say this, risk is never created or destroyed, it's just kind of transmuted. I totally agree with that. Which is say you're not going to beat the marketplace. You're not going to just totally hide invisibly in the marketplace if you have any kind of size. You're going to transmute your risk at some place, whether through price, time, or price and time. And structured products can push some of this around, but it's not ultimately going to change what happens in the marketplace. You're looking at 2020 versus 2022. The rate of change in volatility in 2020 with COVID was extremely high. It was, the market went nuts, vol went nuts. In 2022, the market went down about the same amount, 20%.
Right.
But vol didn't go nuts at all.
Right.
If anything, a lot of those puts, went away and went to money heaven. So that's what I'm talking about, the reaction function. What's the trade? What are you going to do with this stuff? Well, I would say that you can price VIX call spreads, because owning VIX outrights is kind of tough. It gets expensive. Or ratio structures like that. I think they have a better payoff now than they did before a lot of these structured products came onto the marketplace. And I do think they will have an effect. Specifically, I guess the number one thing to consider with this is that if you have a market maker trading with a market maker, and both of them are delta hedging and doing their thing in business land, then there's no net effect in the marketplace. But if you have somebody who's selling a bunch of volatility and then somebody who is doing stuff with that volatility, they're actually doing different stuff. So if you're a buy rider, you're not delta hedging. You sell your options and you wait for them to go to zero. That's it. But if you are a buyer of those options, then you want to buy them at a gamma that you can hedge and make money, or at least cover your theta. So those parties are doing different things in real time. That can have a different effect. And a different effect meaning the structure of the marketplace will change as a result of their participation in the marketplace.
It's an interesting idea, because those funds, particularly if you look at Jeppy and QILD, they're the largest systematic kind of call overriding funds, and they've been able to gather these assets at a time when the S&P itself was just going lights out north, and I think from a total return perspective, those things haven't fared as well as S&P in whole. But if the S&P sort of just starts to track sideways, you could almost make the argument that Jeppy would be a better investment, because you're in theory getting this, yield or dividend, or that they say of 7 or 8%. In which case then gamma would sort of grow. And in theory, that just sort of creates more of like a reflexive feedback loop. And so, I mean, I guess my question to you is that if you start to build on these things, how much more can these things really start to build on themselves? I mean, do you think of this space kind of like everything else, like zero DT immediately went to 50% of volume and then leveled out? Like, how much more asset space can this stuff take up, do you think? Or are we sort of maxed out in this systematic, strategies, do you think? Or is there really a lot more room for growth?
I look at this stuff and I think about it and I don't know. I think there is room to grow.
Mm,
And I think that, again, because if you look at who is buying this stuff and who's selling this stuff, well, if you have $1 billion ETF and you're trying to sell 10,000 options a day or 10,000 options a day for a week for your ETF or something like that, who's buying it? Well, the market makers are buying it, right? It's not just all retail gobbling all this stuff up. Market makers will act as an intermediary, and then they lay that off on the public. But that's fine. Like everyone, ideally what they want is to be long gamma and have it carry.
hmm
It's still not a problem. So if you wanted to sell me 1,000 options and I thought they're overpriced, I wouldn't want to buy them. But if you wanted to sell me 10 million options, but I thought I could carry them, I could sleep at night as much as anybody because I'm not worried about that thing really costing me too much money. The reason you don't want to buy options is because they're going to die and you're not going to make any money. But if you can buy options and have them bleed very little, or maybe even make money because you're scalping stock around it, because what happens is if you're looking at a day-to-day volatility, it might be closer versus the intraday volatility, high, low, close. There might be a wider range and maybe more opportunity there if you're a market maker. So market makers, if you look at Jane Street, Virtu, Citadel, Susquehanna, they're doing fine. So the idea that they can't absorb more gamma right now, I just don't think is there. I don't think we're at our limit.
Mm. And is that so? If you think about Jeppy again, they run things through equity linked notes. These structured products. They're not actually hitting bids and lifting offers or whatever. And I think QILD actually does. You can see their fingerprint in the market. But do you think that they get disadvantaged in terms of price through that structured product like that? If gamma sort of does get filled up, that the prices will change accordingly.
Well, let's invert the question. Do you think they're being advantaged? No way.
I'm trying to let you answer that question.
There's just no chance. So, I mean, if you're a market making firm, right? Yeah. What you want to do is it's just dead common sense. You want to not scare them away. You want to get the business and want to give them the worst price in which you can continue to get the business and continue the relationship.
Right. And so
they're going to be that increment of disadvantagement isn't necessarily punishing to the point where they're going to go out of business. But nobody's going to be doing anybody any favors.
It helps it helps the supply if you can have a little more spread, I guess.
Absolutely. Why would the parasite kill the host? It makes no sense.
Yeah, and the last question I was just asking this one only because I know you've been doing a lot of work with the SIBO recently. Is they recently changed tax treatments on overriding. Do you think that's so? It seems like a lot of the exchanges want to continue to build into this derivative link space. And offering, more short dated products possibly. And so this tax treatment on overriding, seems to be another step to help increase those funds. Is there any sort of major flows that shift the result of that? Or is that mainly just kind of like a side note?
Well, the OCC is part of what's going on with risk and with the SIBO. The SIBO's job is to try to do as much business for the SIBO, come up with new and innovative products, which they've been doing a great job with. But they also have to work in tandem with the exchanges, with the OCC, with the government. So it's not like they work on an island. And just because they want a more favorable tax treatment doesn't mean it's going to work the way they want it to. But their job is to try to create as much liquidity, because what they don't want to do is launch a new product or launch a slightly different version of the same product and have nobody trade it. Nobody cares, right? The spreads are really wide. It's kind of dumb and it doesn't do any business for them. So do I think it will help? Of course it will. If there is a more favorable, if you have two products, one has better, the same product, but one has better tax treatment than the other, clearly this one is going to do better if it's got better tax treatments. Why would it not?
Yeah, makes a lot of sense. And we are talking to Mandy Zhu from the SIBO a little bit later this afternoon, so everyone can tune into that. We're excited for that conversation. As we sort of approach, 30 minutes went very fast. We've been asking everybody kind of this one thing question. And as you step forward again at FOMC tomorrow, and it doesn't have to be a very short dated view, but sort of what's one thing you're really paying attention to, or one thing you could flag for us that we could all sort of watch that maybe we're not paying attention to now? What's kind of one interesting dynamic that you're picking up on?
Man, I love good takeaways. The marketplace right now is basically not freaking out. There is no reason to not to continue to trade. Everybody loves to have a great story and everyone wants to have an angle. Um, but the reality is that the reason I trade volatility is dead simple, is because it's one of the few things that's purely mathematical and it's forward looking. If you look at implied vol, it's forward looking, and jobs aren't forward looking. Owner's equivalent rent isn't forward looking. So these are reasons that you can be a participant in this space. If you look at structured products and you look at how they can affect the marketplace, that is something you might want to look at as these things kind of mapping your logic to 2018, but it's not the same. If they can act as a catalyst to kind of turn the boat over and you get a feel for where is the size and where that size might become too big. But the difference is those people are, rolling their futures in a 15-minute window after the close. Just there's so many differences. And to say that, JEPI is the same as that, it's just not the same at all. It's a totally different trade. Even SVIX, which is a similar thing, still isn't the same. It's a much safer product. Or SVXY, now it's been nerfed by 50%. Again, a lot of the mistakes have been learned from. So the new mistakes are, I think that if the market really does start to fall apart for whatever reasons, and there are these buffered products, I think that there can be a liquidity vacuum down for a while because a lot of the hedges are in place. So if the market was going to go down 12%, it might actually reach further because a lot of that stuff has been buffered out. There's been a lot of protection in the marketplace, and that manifests in reversals, risk reversals, and speed. You see it everywhere. You see the fingerprints of hedging is all over the place behind it.
Do you think there's still a big short put complex out there? I mean, that was kind of the strategies that worked the best.
No.
So the reason I ask that is because do you think that the dealer community or market maker community just has a big kind of long Vega position on, or a moderate long Vega position on, and so they can provide liquidity better as the market goes down, and that just helps to contain realized vol?
No, there's 3 tiers of firms at the OCC. Tier 3 firms have been getting really punished with some of the regulatory changes that the OCC has instituted. The ability for someone to go out there and just sell a zillion puts and have that be useful from a capital usage standpoint is not as good. And not just that, but if you look at, as interest rates go up, that means calls get more expensive and puts get less expensive. So these collar trades are working. So think about what is that doing? When you take interest rates up, you're pricing a forward, and the forward will go higher in price. So even if you just think about this intuitively, calls go up, puts go down. So what you're getting for your puts is even less. So that trade is an inferior trade. It's been working for a long time, but it is, I don't see, there's tons of short puts out there where the marketplace is just going to start to go down and then whoosh. I don't see that at all. If I did, I would trade it. I would put it on.
Yeah.
So I don't have a dog in the fight.
Yeah.
And if I saw a dog, I'd go fight it, but I just don't see it.
Yeah. Because I think some of the conversation last week turned to, Testanet. I think it was this JP Morgan strike last week at the 49.80, if I remember correctly. And so those conversations kind of crept back in about the ability to supply liquidity as a way to suppress volatility, I suppose.
Market making firms are very smart and they have a ton of money. And if you look at, even if my opinion aside, just look at the numbers that are public, they're strong. They are just not in it. You'd be shocked how risk adverse large market making firms are. They don't let stuff go far at all. So the idea that market's going to just go out there and crash, and then, Jane Street and Citadel are going to get ruined today, it's just not going to happen.
Yeah. And to that point, the research we've done recently on zero DT suggests, just sort of backs that point that it's kind of just a money making machine. And that makes sense. Condos in Miami Beach are expensive and
getting pricier every day, man. Private school is up 2x in Brickell.
And the market making firms are buying up those beachside condos, I guess. So
Absolutely.
It's going very well. Well, no, I can't thank you enough for taking the time to join us here today. How can people get a hold of you on Twitter, your website, et cetera, and learn more about you and Convex?
Yeah, on Twitter, I'm at Noel Convex, and our website is convexam.com, convexam. And that's probably the best way to get a hold of me. We're a private hedge fund. We only deal with qualified investors, but we're always happy to chat and talk about new ideas.
That's awesome. I know you're going to be at the EQ Derivatives conference in about a month, and I'm going to be out there too for the first time in about 5 years. So I look forward to seeing you there. And
yeah, that'll be cool. I'm speaking with the SIBO, I think, about dispersion, but I'm not really sure. So I'll probably find out an hour before I have to get up on stage and do my dog and pony show.
You can wing it like we are here. All right. Well, thank you all very much for joining us for this conversation. If you enjoyed the content today, please head over to youtube.com/SpotGamma and you can hit the donate button. And obviously all donations are going to the Susan G. Komen Breast Cancer Foundation. So far, the donations have been great. So thank everyone very much for that. Also, these conversations will be available for replay on YouTube. So if you missed some of what Noel had to say today, you can pick up on rewatch those conversations, over the coming days. I think Jack is going to come on now, and then we will have queue up.
You shall receive, Brent.
Yeah.
Okay.
Jack. Thanks again,
guys.
Noel.